Bear Stearns, how Wall Street's scrappiest firm imploded. In the spring of 2008, Bear Stearns employees watched in disbelief as their stock price plummeted from $57 to $2 per share in a matter of days. The fifth largest investment bank in America, a firm that had survived the Great Depression, Black Monday, and the dot-com crash, was being sold to J.P. Morgan Chase for what amounted to pocket change on Wall Street. The deal valued Bear Stearns at just $1.2 billion, a fraction of the $20 billion it had been worth just 2 years earlier. What made this collapse particularly shocking wasn't just the speed of the firm's demise, but the fact that Bear Stearns had built its reputation on being the scrappiest, most risk-taking firm on Wall Street. The very culture that had made them billions had ultimately destroyed them. This is the story of how an empire built on aggressive risk-taking and street-smart trading became a cautionary tale about the dangers of unchecked ambition in the financial world. Bear Stearns began in 1923 when Joseph Bear, Robert Stearns, and Harold Mayer founded their equity trading business with just $500,000 in capital. From the very beginning, the firm cultivated an image as Wall Street's outsiders, the scrappy underdogs who would take trades that the blue blood firms like Goldman Sachs and Morgan Stanley wouldn't touch. This reputation was partly born out of necessity. The founding partners were Jewish at a time when many of Wall Street's elite firms maintained informal quotas limiting Jewish employees, so Bear Stearns had to carve out its own niche. They specialized in smaller companies, riskier deals, and clients that other firms deemed unworthy. This outsider mentality became deeply embedded in the firm's culture, creating a breed of traders and bankers who prided themselves on being tougher, hungrier, and more willing to bet big than their competitors. By the 1950s, Bear Stearns had established itself as a major player in block trading, handling large institutional trades that required significant capital and risk tolerance. Their willingness to take on these massive positions when others hesitated earned them respect and substantial profits. The firm's empire building accelerated dramatically under the leadership of Cy Lewis, who took control in 1949 and transformed Bear Stearns into a diversified financial powerhouse. Lewis understood that to compete with the established Wall Street elite, Bear Stearns needed to excel in areas where traditional relationship banking mattered less than raw trading skill and market savvy. He expanded the firm's fixed income trading operations, built a formidable research department, and most importantly, established Bear Stearns as a leader in mortgage-backed securities during the 1970s. This early entry into securitization would prove both a blessing and a curse. The firm became one of the first to package home mortgages into bonds that could be sold to investors, essentially creating a new market that generated enormous fees. By 1985, Bear Stearns was handling over 40% of all mortgage-backed securities trading on Wall Street. Their traders developed sophisticated hedging strategies and risk models that allowed them to hold massive inventories of these securities while theoretically limiting their exposure to losses. The mortgage business became so profitable that it eventually represented nearly half of the firm's revenue. The Bear Stearns culture under Alan Ace Greenberg, who became CEO in 1978, epitomized the firm's scrappy, cost-conscious mentality. Greenberg was famous for his frugality, reusing paper clips and rubber bands while demanding that employees turn in their own receipts rather than use expense accounts. He sent company-wide memos about saving money on office supplies while simultaneously approving massive trading positions that put hundreds of millions of dollars at risk. This paradox perfectly captured the Bear Stearns mindset. Penny wise and pound foolish, obsessively controlling small costs while embracing enormous financial risks. Greenberg also institutionalized the firm's meritocratic culture where performance mattered more than pedigree. Unlike other Wall Street firms that recruited primarily from Ivy League schools, Bear Stearns promoted traders and salespeople based purely on their ability to make money. This created an intensely competitive environment where taking risks was not just encouraged, but essential for career advancement. The firm's compensation structure heavily favored short-term profits, with annual bonuses often representing 80% or more of an employee's total compensation. This incentive system encouraged traders to maximize current year profits, even if it meant taking on substantial long-term risks. Throughout the 1980s and 1990s, Bear Stearns' risk-taking culture generated spectacular returns. The firm pioneered many of the complex derivative instruments that would later dominate Wall Street trading, including interest rate swaps, credit default swaps, and
collateralized debt obligations. Their fixed income division became legendary for its ability to make money in any market environment, generating consistent profits even when competitors struggled. The mortgage-backed securities business grew exponentially as housing prices soared, and the government encouraged home ownership through Fannie Mae and Freddie Mac. Bear Stearns traders developed increasingly sophisticated ways to slice and dice mortgage risk, creating securities with different risk profiles that appealed to various types of investors. By 2000, the firm was one of the largest underwriters of mortgage-backed securities in the world, with their traders handling over $100 billion worth of these instruments annually. The profits were enormous, with the mortgage division often generating return on equity exceeding 25%. However, the firm's success increasingly depended on their ability to borrow massive amounts of money to fund their trading positions, a strategy that worked beautifully in good times but created enormous vulnerability when markets turned. The warning signs began appearing in the early 2000s when Jimmy Kane replaced Greenberg as CEO, and the firm's risk-taking reached new extremes. Kane, an avid bridge player who was known to spend weeks away from the office at tournaments, maintained the firm's aggressive culture while paying less attention to day-to-day risk management. Under his leadership, Bear Stearns increased their leverage ratio to over 35 to 1, meaning they borrowed $35 for every dollar of their own capital. This extreme leverage amplified both profits and risks, making the firm incredibly vulnerable to any decline in the value of their assets. The mortgage business grew even more aggressive as Bear Stearns began originating subprime loans through their own lending subsidiaries, then securitizing these risky mortgages and keeping large positions on their books. They also launched 2 hedge funds that concentrated exclusively in mortgage-backed securities, using even higher leverage ratios approaching 100 to 1. The firm's risk management systems, which had been adequate for smaller positions, struggled to keep pace with the complexity and size of their exposures. Internal risk reports showed that Bear Stearns could face catastrophic losses if housing prices declined significantly, but these warnings were largely ignored as the profits continued to roll in. The beginning of the end came in June 2007 when Bear Stearns' 2 mortgage-focused hedge funds collapsed spectacularly, losing over $1.6 billion in investor money within a matter of months. The funds had been leveraged at astronomical levels and concentrated in some of the riskiest segments of the subprime mortgage market, including securities backed by loans made to borrowers with no documentation of income or assets. When housing prices began declining and mortgage defaults soared, the value of these securities plummeted. The fund's creditors demanded additional collateral, forcing fire sales that drove prices down even further. What made the collapse particularly damaging was that Bear Stearns had to bail out one of the funds with $3.2 billion of the firm's own money to prevent even larger losses. This rescue attempt failed to save the funds, but significantly weakened Bear Stearns' capital position, just as the broader mortgage market was beginning to unravel. The hedge fund collapse also revealed that Bear Stearns' risk management was fundamentally flawed, as executives admitted they had not fully understood the risks in their own funds. Credit rating agencies began questioning the firm's risk controls, and competitors started reducing their trading relationships with Bear Stearns, fearing they might be stuck with unpaid obligations if the firm failed.
The final act began in March 2008 when rumors about Bear Stearns' liquidity problems created a classic bank run updated for the modern era. Unlike traditional banks that face runs from depositors, investment banks like Bear Stearns depended on overnight funding from other financial institutions to finance their trading positions. When rumors spread that Bear Stearns might be running out of cash, these funding sources began disappearing. The firm's stock price fell 47% in a single day as hedge funds pulled their prime brokerage accounts and trading counterparts refused to execute transactions. Bear Stearns found itself in an impossible situation. They needed to sell assets to raise cash, but their forced selling drove down prices, which reduced the value of their collateral and made their situation worse. The firm had approximately $18 billion in cash on Monday morning, but by Thursday evening they were essentially bankrupt, having burned through their entire liquidity cushion in just 4 days. The Federal Reserve, fearing that Bear Stearns' collapse would trigger a broader financial crisis, orchestrated the emergency sale to JP Morgan Chase over a weekend. The deal was initially struck at $2 per share, though it was later raised to $10 after Bear Stearns shareholders threatened to reject the offer. The collapse of Bear Stearns represented more than just the failure of a single firm. It was the canary in the coal mine for the entire financial system. The firm's 85-year history demonstrated both the power and the peril of aggressive risk-taking in financial markets. Their willingness to venture where others feared to tread had generated enormous profits and built a formidable franchise. But it also created a culture where prudent risk management was often seen as an impediment to profits rather than a necessity for survival. The same appetite for risk that had made Bear Stearns billions in the mortgage market ultimately destroyed them when that market collapsed. Their extreme leverage, which had amplified returns during good times, made them exceptionally vulnerable when asset prices declined. The firm's demise also highlighted how interconnected modern financial markets had become, as Bear Stearns' failure threatened to trigger a cascade of defaults throughout the financial system. The Federal Reserve's unprecedented intervention to prevent this outcome marked the beginning of the extraordinary government actions that would define the 2008 financial crisis. In the end, Bear Stearns' employees, many of whom had significant portions of their wealth tied up in company stock, saw decades of accumulated wealth evaporate in a matter of days. A stark reminder that in the high-stakes world of Wall Street, empires built on excessive risk-taking can crumble just as quickly as they rise.